I hope you had the opportunity to view my previous video, which was titled Crash Course. In that video, I set the conditions for this video here, which is titled The Next Bull Market, which I believe will be in bonds. And there are several important points to understand about bonds. All interest rates are relative. With more than 10 trillion in debt globally, with negative interest rates, the assumption that interest rates in the U.S. are about to spike higher is likely wrong. Higher yields in the U.S. debt attracts flows of capital from countries with negative yields, which push rates lower in the U.S. Given the economic push by central banks globally to suppress interest rates to keep economic growth going, an eventual zero yield on U.S. debt is not unrealistic. The coming budget deficit balloon. Given the lack of fiscal policy controls in Washington, the budget deficit is set to increase back to 1 trillion or more in the coming years. This will require more government bond issuance to fund future expenditures, which will be magnified during the next recession. Central banks will continue to be a buyer of bonds to maintain the current status quo, but will become more aggressive buyers during the next recession. The next quantitative easing program by the Fed to offset the next economic recession will likely be, in my estimation, from 2 to 4 trillion, which will push the 10-year yields towards zero or negative. In my opinion, the next bull market is coming. It just won't be in stocks. It will be in the U.S. Treasury market, which will coincide with the next recessionary drag in the economy. Interest rates have everything to do with economic growth. Since economic growth is almost 70% driven by consumption, with saving rates extraordinarily low and debt hitting record levels, small increases to interest rates will have an immediate negative impact on the consumption capability of U.S. citizens. And this may cause a stock market crash. If I'm right, that crash will presage the next bull market in bonds. So let's take a look. And as shown in this chart here, the bond yields rise during periods of quantitative easing. And we've been through the quantitative easing through QE3. And as you can see, following the quantitative easing or with a tapering, that's when bond yields decline. So here we are here just under 3% on the 10-year yield. And as the previous video, I indicated that we're supposed to have the expected or forecasted tapering of the quantitative easing. If that is true, then bond yields will decline. Now, if the tapering doesn't happen, bond yields should stay about the same. If we happen to have a stock market crash, bond yields will go down or decline in that scenario as well, but only increase when QE4 takes place, and the Fed is always late. They will not initiate QE4 until after a stock market crash or way late. Either way, bond yields are going to stay the same or more likely decline from here. Let's go to the next chart. And you may have seen versions of this chart before, and I will likely have other versions of this chart later in this video here. But going back to 1980, as you can see, the decline in bond rates. Now, what is interesting is the trend line that has been drawn. And you can see that each time the yield approached that trend line, we had an event. Beginning with Black Monday, which was in 1987, the S&L crisis, the Japan bubble burst. If you took a look at that population chart from the previous video, you see that Japan's population and working population started to decline when back in 1989 or thereabouts. Then it was followed by the tequila crisis. I was drunk at that point in time, so I can't tell you too much about it. Then we had the dot-com bubble burst in the year 2000, the global financial crisis in 2008, 2009, and now again we are approaching, and by this chart we show that we're through that trend line. Other charts don't show that we have pierced through the trend line. It's showing that we're approaching the trend line, but nonetheless, you get the idea. Every time we approach that trend line, an event happens. What is the next event that's going to happen? I think we're going to have some trouble in the stock market. And this is a great chart here showing the U.S. 10-year Treasury yield over the past 55 years going back to 1962. No trend lines here, but I think you can take a look at it and easily come to the conclusion that we did have the peak in the 10-year Treasury yield there in early 1980s. And interestingly, if you go ahead and line that up with a population chart and with a labor chart of the U.S., you will see that the peak baby boomer income, spending, and population occurs at about the same time and has been declining since then. To me, there's a strong correlation, maybe not causal, but a strong correlation. And there we are at the very lower right at the current bond price of just under about 3% on the 10-year Treasury. So a good overall look over the past 55 years. Now, are you going to tell me that today that trend line going back to 1980 has all of a sudden changed and turned? It's not likely. In my opinion, it's likely that that trend is going to continue and the bond yields will go to zero, if not negative. Let's go to the next chart. And this chart here, which is a much more contemporary and current chart on the 10-year yield. What I like about this chart here is you can see the coincidence between the peaks in the 10-year yield along with the RSI pushing up into overbought territory. We see that here, followed by here, this time frame, here, and then now in early 2018, RSI has pushed into the overbought territory, and then the yield is up here just under 3%. So in my opinion, it looks like the bond yields, at least the 10-year, is topping out. Let's go to the next chart. And this chart here showing the very coincident charts of the 10-year yield along with the flattening or inversion of the yield curve. It isn't necessarily causal, but again, the correlation is striking. And you can see that in the inversion periods or the flattening of the yield curve, that's when it coincides with peaks in the 10-year yield, each of these cases here. And now, as we've seen in the previous video, we have a yield curve that is heading down and flattening. So in my opinion, I think that the 10-year yield at this point here is also topping out. Another coincident feature. Let's go to the next chart. And this is a nice clear chart here showing the U.S. Treasury 10-year bond yield. And you can see each time that the yield approaches that trend line, there are problems, various problems, almost in every case. And again, in the lower right, we show that the yield has pierced through that trend line. But then again, not every chart does the 10-year show that it's pierced through the trend line. In most of the chart, it shows that the 10-year is approaching that trend line. So it just depends upon what sort of time frame that you're looking at. This one here, they show it piercing through. But I think the point being is every time that that yield approaches that trend line, that's when we have problems. And you may ask the question of why does the yield at this level, at 3% or so, cause a problem when in previous times it needed to cross through that trend line, say maybe at 9 8%, 7%, perhaps 5%. Well, with the amount of personal, corporate, and governmental debt out there, the trigger point is much easier to reach, particularly with how much debt has been piled on in the last few years. A minor or marginal difference in that yield rate has a huge effect on all those outstanding loans, including credit card, auto, and student loans. It takes only a small fraction of a move now to cause a problem. Let's go to the last chart. And this last chart here from Real Investment Advice needs a little bit of explanation. In the upper portion, this is the Williams. This is the Williams ratio. And again, this is the 10-year yield. So we see that even in the Williams, such as in the RSI, we're in overbought territory on the 10-year yield. In this lower portion here, we have the S&P in the black going all the way back here prior to 1970. It looks like 1968 here. This orange line is the yield rate over this period of time from 1968 all the way to the current time frame. Now, above and below that line are what's called Bollinger Bands. And according to the author, the current interest rates are 4 standard deviations above their 1-year moving average. And the question becomes, how often has this happened going back to 1965? Well, never. And negative events such as the S&L crisis, the Asian contagion, long-term capital management, etc., all drove money out of stocks and into bonds, pushing rates lower. Recessionary environments are especially prone at suppressing rates further. And given the current low level of interest rates, the next recessionary bout in the economy will likely see rates near zero and unleashing the next bull market, in my opinion, in bonds. And my friends, things are only starting to get interesting. So for today, that's ChewDog Charts. Thank you.